Today, we're going to pull back the curtain on a charting technique that's been around for over 100 years. But you know what? It is incredibly good at cutting through all the noise of today's markets. It's called point and figure, and it's all about one thing, focusing purely on price. So, have you ever pulled up a stock chart and just felt overwhelmed? You know what I mean. All those little wiggles, the tiny ups and downs. It's just so much noise. It feels like static. It makes it almost impossible to see what the heck is really going on with the trend.
Okay, let's get into what this is all about. Point and figure charting, or P&F for short, is a totally unique way of looking at the market. See, most charts you look at are plotting price against time. P&F throws time right out the window. It only plots price moves that are actually significant, which helps filter out all that noise and gives you a much cleaner, more objective view of supply and demand. So why bother learning this? Well, the benefits are pretty amazing. First off, it gets rid of all that distracting market noise. This gives you a truly objective look at the trend. It also makes spotting key support and resistance levels super clear. And here's the really cool part. It gives you a way to calculate price targets that can be, well, uncannily accurate. So here's what we're going to cover. We'll start with what point and figure actually is. Then we'll get our hands dirty and learn how to build a chart. After that, we'll decode the basic patterns, learn how to set those price targets, and finally, wrap it all up into a trading strategy. All right, let's get practical. We're going to jump right into the fundamentals of how these charts are actually put together. And trust me, it's way simpler than it looks. There are really just three core parts you need to get set up. First is the box size. This is simply how much of a price change each little X or O on the chart stands for. Second is the reversal size. This tells you how far the price has to move in the opposite direction before you start a brand new column. Now, the most common setting here is a 3-box reversal. And finally, the easy part, how to plot. We use X's for prices going up and O's for prices going down. That's it. Everything, and I mean everything, starts with the raw data. So what we're looking at here is just a plain old list of closing prices for a stock. This is our input, and we're about to transform this into something clean, simple, and totally noise-free. Now watch this. As the price goes up by our box size, we fill in a box with an X. And we keep stacking X's in that same column as long as the price keeps climbing. But the second the price drops by our reversal amount, which is 3 boxes in this case, we hop one column over to the right and start a new column, this time with O's. And here's the final results. I mean, look at that. What you get is a chart that shows you the major uptrends with those columns of X's and the major downtrends with the columns of O's. All the little insignificant price wiggles, they're just gone. This is pure supply and demand in visual form. Okay, so now we know how to build one of these charts. Let's get to the fun part, figuring out what it's trying to tell us. P&F charts create these really clear, objective patterns that can signal some pretty interesting trading opportunities. This shows some of the bread and butter P&F patterns. Let's just focus on a couple of the most common ones. Over on the left, you've got a classic buy signal called the triple top breakout. This happens when a column of X's pushes higher than the last 2 X columns. On the right, you have its evil twin, the triple bottom breakdown, which is a clear sell signal. You can see how these patterns give you very obvious points to consider for entry or exit. You know, it's not just about simple up and down moves. P&F charts are fantastic at showing you when the market is just coiling up, getting ready for its next big move. A perfect example is this bullish triangle. See how the price is getting squeezed between lower highs and higher lows? The real signal, the thing to watch for, is when the price finally breaks out of that tight pattern. That's your cue. Now, this is something I find really fascinating. Let's talk about trend lines. On a normal chart, drawing trend lines can kind of subjective, right? But on a P&F chart, they are always drawn at a perfect 45-degree angle from a major high or low. This makes your trend analysis totally objective. There's no guesswork. A break of that 45-degree line is a clear, unmistakable signal. And that brings us to what might be the most powerful, most unique feature of point and figure charting. Its uncanny ability to project where the price might actually be going after a breakout. Now, this isn't some kind of magic or guesswork. P&F gives you actual, objective formulas to calculate these price targets. They're known as vertical and horizontal counts, and they're based on the size and shape of the patterns on the chart. It's a data-driven way to project potential price moves. Let's walk through a vertical count with a real example so you can see how it works. To find an upside target, first you find a big, significant low on the chart. From there, you just count the number of X's in that first column that goes up. Then you multiply that number by your box size and then by your reversal amount. Finally, you add that result back to your starting low price. So, in the example right here, the low is $6.90. You do the math, and boom, it projects a potential price target of $14.55. And for downside targets, you just do the exact same thing, but in reverse, starting from a significant high. Okay, so we've learned how to build the chart, read the patterns, and even calculate where the price might go. Now for the most important part, how do we actually use all this to trade with a bit more confidence?
So here's the key. You don't just blindly trade every single pattern you see. That's a recipe for disaster. You want to look for the really high probability setups. That usually means focusing on breakouts that come after a period of sideways action, what P&F folks call congestion. That's where supply and demand are battling it out before a big move. And you always want to try to trade in the direction of that main 45-degree trend line. Oh, and the chart gives you a perfect place for your stop loss, right below a recent column low. When you combine that with your price target, you can calculate your risk-to-reward ratio before you even put a dollar on the line.
And believe it or not, the usefulness of P&F doesn't stop with individual charts. These core ideas that a stock is either on a buy signal or a sell signal are actually the building blocks for some really powerful market breadth indicators, like the bullish percent index, which helps you gauge the overall health of an entire stock market index.
At the end of the day, you shouldn't think of point and figure as the only tool you'll ever need. It's not a magic bullet. Instead, think of it as this incredibly powerful addition to your trading toolbox. It gives you a unique, totally objective view on price that can either confirm what you're seeing elsewhere or maybe even challenge it, giving you a whole new level of clarity.
So I'll leave you with this to think about. When you take time completely out of the equation and focus only on what the price is actually doing, point and figure forces you to ask the single most important question a trader can ask. Is the trend truly on my side?